Good morning, investors. This is Morning Download. We focus on what actually matters, not the headlines, not the noise, but the second-order effects shaping money, markets, and retirement decisions. Most money conversations stop at habits and rules. That surface view sounds practical, but it misses timing, trade-offs, and constraints. For retirees, the risk is not lifestyle choices alone. It is how those choices interact with cash flow, taxes, inflation, and longevity. Ignoring those downstream effects creates confidence without durability. Reframing timeless money principles. The common framing is that wealth comes from discipline and simplicity. That is directionally true, but incomplete. The real impact shows up years later when flexibility matters more than accumulation. Retirement is less about maximizing totals and more about preserving options under uncertainty. What follows is an analytical read of several long-standing money principles. The focus is not moral value or motivation. It is how these behaviors change risk exposure across a retirement timeline. Aligning spending with core values. At first order, aligning spending with personal priorities reduces waste. It lowers the chance of regret-driven purchases. At second order, it stabilizes retirement cash flow. Spending that reflects durable priorities tends to be more predictable. Predictability matters because retirees fund expenses from finite portfolios. This reduces behavioral risk. Less impulse spending lowers the chance of drawing down assets aggressively in early retirement. That early period matters because losses or overspending then amplify sequence of returns risk. What this does not solve is inflation mismatch. Spending aligned with values can still be concentrated in categories that inflate faster, such as healthcare or housing. Alignment helps discipline, not purchasing power, prioritizing time over extra income. On the surface, this idea values life balance over earning more. The deeper effect is on human capital durability. Time invested in relationships and health tends to reduce late life costs. Health degradation and social isolation often translate into higher medical and support expenses. Those expenses arrive late when portfolio recovery is harder. There is a trade-off. Less income earlier can mean lower savings. The benefit depends on whether reduced income meaningfully lowers stress and health risk. This principle mitigates longevity risk indirectly. It does not increase portfolio size. It potentially reduces the tail risk of catastrophic late life costs. Investing in personal growth. At first order, education and skills can increase earning power. That is the visible benefit. The second order effect is adaptability. Careers rarely end cleanly at a single date. Skills allow partial work, consulting, or flexible income later in life. This optional income reduces pressure on portfolios. It can delay withdrawals or smooth market downturns. That directly lowers sequence risk in the early retirement years. This does not guarantee income. Markets for skills change. Health and age discrimination can limit access. The benefit is optionality, not certainty. Avoiding debt that limits future choices. Debt avoidance is often framed as peace of mind. The structural effect is balance sheet resilience. Fixed obligations reduce flexibility during shocks. For retirees, that includes market drawdowns, medical events, or family support needs. Lower debt reduces forced withdrawals. It also lowers the risk of selling assets at unfavorable prices. That matters most early in retirement when portfolios are largest and most exposed. The trade-off is opportunity cost. Some debt can coexist with investment growth. The risk is not debt itself, but rigidity, practicing mindful resource use. Small savings are often dismissed as trivial. Over decades, they shape behavior more than balances. The second order effect is consistency. Habitual awareness of consumption supports steady contribution patterns during working years. Consistency matters more than optimization. In retirement, this awareness can slow spending creep. Spending creep is a behavioral risk where expenses rise quietly with time. It erodes real purchasing power, especially under uneven inflation. This does not eliminate inflation. It moderates response to it, embracing a simpler lifestyle. Simplicity reduces visible costs. Its deeper impact is on fixed versus discretionary expenses. Lower fixed costs increase flexibility. Flexibility allows retirees to adjust spending during market stress without cutting essentials. This reduces the chance of panic selling. When essentials are lean, temporary cutbacks are less disruptive. The trade-off is personal satisfaction. Simplicity that conflicts with deeply held preferences can backfire. Deprivation increases the risk of later overspending. Choosing used vehicles over new ones. The first order argument is depreciation. New vehicles lose value quickly. The second order effect is capital allocation. Large depreciating purchases reduce investable assets during peak earning years. That reduces compounding, which cannot be recovered later. For retirees, transportation is often a fixed cost. Lower ownership costs reduce pressure on monthly withdrawals. This does not account for reliability variance. Maintenance uncertainty can introduce episodic costs. The principle reduces expected cost, not variance. Focusing on value, not just low cost. Value-based spending is often misunderstood as frugality. The deeper distinction is durability. The durable purchases reduce replacement cycles. That lowers long-term cash flow volatility. In retirement, volatility matters as much as totals. Unplanned expenses force asset sales at unknown market levels. This approach also supports selective generosity. Allowing spending in high-value areas reduces behavioral backlash. That can stabilize overall spending patterns over time. What these principles collectively change. Together, these behaviors do not guarantee wealth. They reshape risk exposure, they reduce forced decisions, they increase optionality, they lower the probability of making irreversible choices during stress. They also interact with policy and tax drift. Rules around taxation, healthcare, and benefits change gradually. Flexibility allows adaptation without crisis. What they do not address directly is market risk. Portfolios remain exposed to returns, inflation, and timing. Behavior and structure can mitigate damage, not eliminate it. The retirement system context. Retirement is a long-duration system. Cash flows span decades, costs inflate unevenly, health risks cluster late. Early retirement years carry disproportionate risk. Losses or overspending then permanently lower future capacity. Later years concentrate care-related costs that are difficult to predict. The principles discussed mainly operate on behavior and structure. They work best before and early in retirement. They are weaker against late-life medical tail risk. That gap is not a failure. It is a boundary condition. Closing perspective. Timeless money habits matter less as rules and more as constraints. They shape how many choices remain available when conditions change. In retirement, outcomes are driven by second-order effects. Flexibility beats optimization. Predictability beats precision. Optionality beats confidence. Understanding those dynamics matters more than any single tactic. Morning download products and services are offered for educational and informational purposes only and should not be construed as a securities-related offer or solicitation or be relied upon as personalized financial advice. For more, visit morningdownload.com and please do not forget to like this video and subscribe to this channel for more retirement information. Link to the original post is in the comments below.